This episode is brought to you by True America Multifamily, one of the nation's leading multifamily investment firms. With more than 60,000 units across nearly 300 properties and about $16 billion in assets under management. In 2025, True America partnered with Manulife Investment Management to launch the $1 billion joint venture, Anchor Point Residential, created to acquire and preserve income-restricted multifamily communities, supported by low-income housing tax credits, LIHTC. The initiative begins with 51 properties, about 6,000 units, across California, Texas, and Washington. On today's episode, Scott Rechler, Chairman and CEO of RXR, and Jason Post, Founder and Chairman of Post Investment Group, both join Bob on the podcast.
Hi, everybody. Welcome to episode 4 of the Building Better Communities podcast. I'm Bob Hart, your host, CEO of True America Multifamily. I am honored today because I have two very, very accomplished guests on. I have Scott Rechler, the Chairman and founder of RXR in New York, and Jason Post, the chairman and founder of the Post Realty Group in California. So since we're in California, I'm going to start with Jason. And Jason, I'm going to give you a little intro on your background, although it probably most of the viewers will know who you are. But you founded your company in 2007. You entered real estate at, I believe, that time. I think you were doing some syndications before then. You've built it to a company with about $5 billion or more of AUM by now, 45,000 units nationwide, a big focus on workforce and affordable housing, and a vertically integrated company doing acquisition, financing, construction management, and total repositioning of deals. In addition to that, you're a serial entrepreneur in the Post Investment Group, which runs other businesses and ventures outside of real estate, which include wellness and other consumer sectors. You're a bit of a contrarian. You're known for being aware of the change of cycles, and you'll continue probably to do that throughout your career. We'll hear more about that today. And you've been a great advocate throughout the United States for affordable housing and structuring deals to public-private partnerships and subsidy programs, which is a different language in of itself, one that we're trying to learn something about. And I know you're very philanthropic. You serve on a number of boards, including one very close to you, which is the Anti-Recidivism Coalition, or ARC, the Wendt Museum, Cedars-Sinai's Board of Governors, and Wags and Walks. You're a man of my own heart with that I have a bunch of dogs, and I know you do too. So there you go. And you've been on other podcasts, including Investing Late in the Cycle, which I just listened to a little while ago, the U.S. Multifamily Outlook, Are We in a Bubble, and a number of things. And happily married to your, I don't know if she was your high school sweetheart, but I know you've been married to her a long time, Gara, who's also a serial entrepreneur. And just like Scott, you grew up in Long Island. You attended Arizona State with a bachelor's degree. And here you are. So welcome, Jason.
Thank you.
All right. To Jason's, I guess it would be to the right of the viewer, is none other than Scott Rechler. Scott is someone I've gotten to know here over the last 2 years, and his name is well recognized, particularly among the circles of real estate in New York and throughout the country. He's a frequent contributor to CNBC, many other podcasts, and is very involved in the entire New York real estate community, both in the commercial sector, in residential, and has really a national platform doing development primarily in the multifamily space, although I think they've been buying a little bit lately as well, and doing adaptive reuse, rebuilding airports, serving as a director of the Federal Reserve Bank of New York. A lot of tougher, bigger, creative deal making, and we'll talk about that today. You have been, or maybe still, a host of the Recalibrate Reality series, Post-Crisis Urban Recovery, and as I said, very involved in media as well. You built RXR as a follow-on to your family company, Rexon, which was sold to SL Green, and your ventures are epic. American Campus Communities, acquired that, took it public to Blackstone. A man of my own heart. He went to school at Clark University in Worcester, Mass, right down the street from where I went to school at WPI. I think I was in a better neighborhood than you, Scott, though. But growing up in New York, it was probably pretty easy. And then you're also a graduate of the Shack School at NYU. And I know you've been married a long time to Debbie. I think you met in college, and you have 3 children.
That's correct.
Okay. So let's get into it. Today, we want to talk about what's happening coast to coast in terms of a little bit of the political ideology that's shaping housing, a little bit about zoning issues and development issues, and kind of examine the intersection of where politics, policy, and capital create a confluence that influences how housing is getting built, redeveloped, adapted from office buildings, and so forth. So we'll gain those perspectives through the major markets that both Scott and Jason operate in, and we'll also talk about their ownership history, how they advocate, how they obtain capital, and so forth. So the thing we want to emphasize here is, can cities like New York and Los Angeles and Dallas and San Francisco thrive if the political winds are difficult and private investment wanes? So let's start at 30,000 feet. How would each of you describe the current housing environment in your regions that you operate in? I know you operate nationally, Scott. What's the real issue that could be holding us back right now?
So again, I'll speak of the New York metro region, since that's where we have a bulk of our portfolio, and the big issue is supply. We have in Manhattan, New York City, a 1.5% vacancy rate. Very difficult to build new housing in New York at a price that makes sense, and that's something that continues to be a challenge. And with land basis as high as it is, where there is supply. It needs to be obviously luxury housing, or it needs to be condominiums, and we've had policies in the past that actually had encouraged more affordable housing, like 421A, which was in New York, which was a tax incentive that provided a abatement on real estate taxes that enabled a significant amount of housing to be built that no longer exists. And we'll talk more about some of these policy problems, but this is the replacement policy is ineffective in terms of enabling housing to be built, because it has so many different requirements in terms of labor and environmental, et cetera, that it's not happening. And what we've had is a population boom of jobs in New York over the last 4 years, almost 1 million jobs. But we have, in terms of housing units in all of New York City, less than 400,000 units of housing built, right? So this is why we have this very tight
a city of what, 8 million people?
8 million people, correct. And
a
again,
million people returning to work.
Right. And I think in New York, again, as a region, right? So there's 20 million people when you think about the region and connectivity through the transit system, which we have as a big asset to us in New York, which you can then, move out. And the challenge when you go to the outer suburbs and boroughs is that it also is very restrictive in terms of new development. And so, in the markets where you can get development, approved, it does very well, but it takes a long time, very costly, land's very costly to get that approved. So it's a big issue. It's an issue, frankly, that is not just obviously a New York issue, as we'll hear from Jason when he speaks about what's happening in the markets that he operates, but we see it everywhere. And I would say just politically, and we're already seeing this election here in the mayoral race in New York. I think you're going to see it in the midterm election. I think you're seeing in the presidential election that the lack of housing supply and affordable at every level of housing, not just the small A or big A affordable, but every affordable housing is going to be one of our country's biggest policy challenges, and not an easy one to fix.
No, and I think that's why we're hearing the word affordable repeated both at the local, state, and national level of how to fix that. But the challenge is getting the zoning and other incentives in place to allow for sufficient density, ease of tax treatment sometimes. Like I know you're doing a very large adaptive reuse project in Manhattan, and I think I heard you say in another podcast that it's going to cost all in about 800,000 a unit. So that's definitely going to be renters by choice to make those numbers work.
Right. Well, and there will be in those instances because there is a program that we're using called 467M that was put in place that it
467M.
yeah, that encourages incentivizes the adaptive reuse of older office buildings into residential, and so we're
What are you
doing
getting from the government to help with that?
yeah, so it's 90% tax abatement, real estate tax abatement for 35 years. So it really is a game changer relative to opening the aperture of what buildings would be able to be qualified. So historically, adaptive reuse of office to residential was really more a lower Manhattan older office building, which we're doing a almost 1,000 unit project down Lower Manhattan right now in 61 Broadway. But we're also doing 5 Times Square, which is a 1,200 unit conversion of the old Ernst & Young headquarters into residential on 42nd Street and 7th Avenue, right? So I would never have thought that would qualify, but this has opened that, and we're seeing that with the others at the Pfizer building on in Midtown. So there's an evolution now of more housing being built in these Midtown neighborhoods, which is critical because otherwise we'd have empty office buildings and these assets that were once economic generators would be economic detractors, and now we're creating these little nodes of communities where you have office people living, which then retail then is activated 7 days a week, and the sort of 15-minute walkable neighborhoods in Midtown as well.
It's amazing that you're able to do that and make the numbers work. What do you think that property tax abatement inures to on a spread or a cap rate basis to help make your deal work? You think it's a couple hundred basis points?
Yeah, I'd say it's about probably 150 basis points.
150.
Yeah.
So if it was costing you, call it you were building to a 5.5, you'd really be building to a 7 as a result of that, which helps you make your numbers work.
Right. And at 5.5, in today's world, that would be very difficult to do right now. And again, in New York, there is a 1.5% vacancy, right? So if you build it, they will come. But that's, at some point you gotta wonder when they stop coming because the rent keeps going up. And that's, as you said, we're in many markets around the country. In our markets in the Sun Belt, we're seeing rents flat to down on new leases, up on renewals. But in New York and the New York region, we're seeing rents up on new and renewals because there's just a scarcity of supply.
Yeah, but that overlay to help with blighted buildings or empty buildings has a double bottom line effect because not only are you creating more housing, albeit for a renter by choice, which puts supply in the market, you're revitalizing pockets of neighborhoods that otherwise would be dormant.
Absolutely right. And listen, I think
when we doing something good here, correct, Scott?
Doing good and doing well means doing better, as our saying. But I think it's a fair point, and I think it speaks to this plus housing in general, right? Which is this is not just a commercial effort, and this is also a civic responsibility, right? We need to if we don't go and address some of these challenges, the ecosystem, the urban ecosystems can't function. And so if you don't have housing to be able to attract and house the talent that's coming here, then companies aren't going to come here, then retailers aren't going to be here. You don't have enough people to support your public transit system. It becomes a self-reinforcing positive cycle can become a negative cycle. And that's why this is such a important priority moving forward.
Before I switch to Jason here for a second, you touched on an issue here because obviously you're taking a risk with your capital and your investors' capital to do this. How do you feel about the current, what appears to be changes in the mayoral political environment in New York that could affect what you're doing, such as this project on Broadway in a future iteration, 2 or 3 years from now?
Yeah, so I mean, I think if there is a Mayor Mamdani who's been clear that he will one of his objectives and policies would be to freeze rent on regulated housing. Now, in these programs that I just mentioned, they're 20% to regulated to 30% if you're using the prior program. So what we're underwriting is no growth in rent on those apartments.
So no growth in rent during the hold.
On the 20 and 30% ones, yeah.
Okay.
Just on the regular, just on the
So,
rent regulated ones.
so you have an affordable component in your
That's how
deal.
you need to qualify for the program, right? That's how
Okay.
the program works. And so we'll do that. But the reality is, what's it really going to do? It's going to reduce supply, right? That's what happens. It's going to, when you say rent freezes, it freezes capital, it freezes projects, it reduces supply. And so the beneficiary may be the people that are living in those affordable rent regulated apartments for a couple years. But then even they, as expenses go up, they need capital improvements. Owners and landlords have no incentive to invest in those apartments. People have no incentive to build new in this market. And so you'll have a
No
contraction.
jobs created from that.
Right. So
Nothing.
you have an exacerbation of the problem that New York faces. And it's been, this has been tested and there's been a lot of research written about this, which is, just freezing rents itself, reduces supply, and that the real answer to actually reduce the cost of rents is building new supply. And and that's at every level. I mean, the Minneapolis Fed had a really good report that showed that even if you're building luxury housing in a market, it cascades down and creates more affordable housing because people who are living in affordable move up to the luxury end of the chain and then open up affordable housing, right? So the answer to affordability is supply, supply, supply at every level.
I think that's a good title for a new book, Scott. Let me fly the plane back to the West. LA has got its own issues, maybe a microcosm of what you have in New York, but still a very highly regulated environment. Southern California, even California, throughout the West Coast. Jason, you've invested up and down the West Coast. How would you describe the current housing environment, and what do you think is holding us back out here?
So for starters, we do cover the country. We are coast to coast. So we have perspective on the Sunbelt states as well as the West Coast as a whole. There's no question that in California, especially Los Angeles, but in the totality of California, we're supply constrained. We have an aging and deteriorated housing stock, and it's a proximate result of restrictive zoning, NIMBYism, and it's the requirement of the government incentives to build this deep affordable housing, which just continues to skyrocket the cost to build affordable housing. To illustrate, it costs about $300,000 a unit to build a market rate apartment in California, market dependent. And for an affordable housing project, it's not less than 2x that cost. And very oftentimes, depending on the market you're in, like I say, San Jose, it's 3x that cost. So to build
union labor, what are the things that are driving that?
Well, so the incentives, the various incentives come with further restrictions, right? So when you're applying for finite incentives like tax credits, they're going through an application process, and in order to win your application or your allocation of tax credits, the requirement oftentimes is deep affordability. And in and of itself, that's fine. The problem is that then you need additional incentives on top of those credits. As a result of those additional incentives, there's more requirements that get tacked on. So it's this never-ending race to the bottom. It's better, in my opinion, it's better to echo what Scott said a moment ago. Let developers do what we do best. Let's build, let's increase supply, right? Let's build great market rate housing at $300,000 a unit. And then I'm a big proponent of taking those government incentives and converting existing non-affordable housing stock, but existing built stock that you can buy for $150,000 a unit. Use those incentives to renovate those properties and to put restrictions on those. So
to
take
build a
incentives to
300,000
convert
a
assets.
unit, Jason, don't we need more density to accomplish that kind of a number, or do you think that can be done even with the existing zoning laws?
So one of the things that has gone relatively well at the state level is there's been the state kind of takeover, so to speak, of local zoning laws. So cities like Los Angeles don't like this, but Gavin Newsom just signed into law SB 79, which will immediately enable developers to build 65 feet in single-family zone neighborhoods that are within a quarter-mile of a major bus stop or any transit station. And once you go further out, about a half a mile out, it's about 55 feet of density.
So 6-story wood frame buildings.
In single-family.
If you're driving down Sherman Way or Washington Boulevard, you could get rid of some of these courtyard buildings and honky-tonk retail and construct call it a 5 or 6-story building.
I'll give you a better one. You could do it at the corner of Wilshire Boulevard and Beverly Drive in the heart of Beverly Hills, and you can go into the flats of South Beverly Hills and take a single-family residential lot and do something like this.
Aren't the neighborhood associations still going to fight you, though, Jason, on that?
Oh, I mean, it's state law. So the cities are trying to fight it. They look at this as an illegal taking of their ability to control their own zoning. So it will be litigated. There's other laws as well that we actually have been taking advantage of, which California allows property owners to build 8 units per legal lot they have on existing properties without the requirement to increase parking ratios. So we've been taking advantage of that on properties we own up and down the state. We might own a 300-unit garden-style building in San Jose that's located on 3 or 4 different lots, and we can add 24 or 32 units without regards to parking, without having to obtain any sort of entitlements or rezoning. So there's some good policies. But here, I'm a big proponent, though, of just take the gloves off. Look what's going on in Texas. You look in Austin, Texas, San Antonio. You look in Charlotte, North Carolina. The occupancies in these markets are in the 80s. The rents are through the floor right now, and this is just a function of unrestricted, no restrictions on developers.
No.
And they've just built. And Denver is a good example of how you can legislate your way back into a housing crisis. So Denver is something like 33,000 permits a year being pulled. They built their way out of a housing crisis. Occupancies are in the mid 80s, rents are down, and all of a sudden, 3 years ago, the city of Denver passes an ordinance that requires that you set aside it's either 15 or 20% of your units for 60% AMI, and building permits fell off a cliff. And literally, they're going to legislate their way back into a housing crisis. It's unbelievable. Government can't get out of the way.
Have been a pretty steady, even flowing market for a long time. Now, Scott, you're doing something in Denver, aren't you?
Yeah, no, we're building a new building, but to Jason's point, we're being forced to build now where I would normally hold off, because if we wait, we're going to have to be subject to that new legislation of the affordable housing. And so, it's a 400 plus unit development in an op zone in Rhino in Denver, that right on the rail line over there. But so we're going to go forward with it. Now, again, it's a longer hold because of the op zone. So it gives us some time to the fact that they're going to actually cut zoning, right? I mean, change the zoning, reduce supply, will hopefully push rents up from a commercial standpoint. But I mean, another good example in our neck of the woods in New York too is we have in a city, New Rochelle, where they had a pretty I think constructive, thoughtful the city government and mayor. They put a master zoning overlay over the whole downtown around the train station
In New Rochelle.
In New Rochelle. And basically just laid a playbook out and said, okay, any developer that comes in that follows these rules, and you can have a menu of density, tax incentives, affordability, community benefits. Within 90 days, you're going to get your approvals. And they rezoned over
90 days.
90 days, and there's 11,000 units that have been rezoned for that. And we're a master developer, so we have the right to develop on the city's parking lots and old municipal buildings. But it's open to everyone. And so what you've seen is this surge of supply in New Rochelle and revitalization of this downtown that was economically strained, a drop in crime, an increase in retail and sales and activity on the streets. Schools are better because of it as people have come in, and rents are flat, right? And then if you go to every other suburban community around that, rents are up 30%, right? So it's a good example of, and it's 30 minutes away by train to Manhattan. So it's, you can live in an urban suburban environment where good government policy, in this instance, was able to create supply, revitalize his downtown, and keep rents flat.
What's interesting, and I don't know if this is lost on people sometimes, is that the opposite occurs as a result of bad policy. Because when there's bad policy that constrains supply, unless you're rent regulated, the landlord benefits because the rents will be higher. And then the opposite happens, as it happened in Austin and other markets where unbridled development, you have a lot of choices for the renter, and suddenly rents are falling.
Yep. No, exactly.
There's a balance
That's
there.
why policy is key. And the comment that Jason was talking about, this California state law, they tried that in New York, the governor, and got so much pushback from municipalities that she had to drop it. But that is part of the challenge, right? I mean, the part of the challenge is that you have these communities that, as Jason said before, can be NIMBYism, right? And they don't want development in their backyard. And because of that, the broader state or community suffers from that, right? And that is a challenge that we have to overcome. And I do think the fact that this is getting such focus, that the housing shortage in this country is getting so much focus, that it's going to have to break through that at some point. Now, are you better off using sticks and restrictions or carrots and incentives? And maybe I think in many markets, the incentives are going to be what works more to encourage new housing versus the sticks. But it may not be enough in some of these markets.
What's interesting, and maybe it's not the best contrast, but if you look at the last 20-year development of China in many, many areas, with the movement from, call it the agrarian areas of China to the more industrial and urban areas of China, there's a federal government move there where they're basically taking land by eminent domain, allowing dense high-rise buildings to house their workers, and everybody's singing off the same hymn sheet. There's no bifurcation between local, state, and federal government. And here we have so many layers of government. It's hard to get everybody rowing in the same boat.
No,
and so many people with their hands out that want to get paid.
I was just going to say the same thing, Jason. I was going to say, I mean, not only layers of government, you have layers of stakeholders, right? Interest groups, labor, environmentalist, local businesses, you name it, it's there, right? And so what happens is it's like what Ezra Klein called the everything bagel, that they keep putting more and more on to the bagel that's not edible anymore. No one's going to go forward, and that is the problem, and that is why
Unless you scoop it out, Scott.
I know, right? You scoop it out, right? But that is the challenge, right? And that is, and I think that and that's still part of the problem is that those power bases, right? The labor, environmentalists, they're the ones that are the most vocal. They're the ones that are in the face of those elected officials. The people that are looking for the homes aren't organized, right? Developers, we're not in the position where we can have as much grassroots pull, and so our voices don't resonate like they resonate, right? And that's the ones that ultimately are driving the tip of the spear of these policies.
I mean, I'd say one thing about New York, right? As an example, like free is not a sustainable business model. So for someone to come in and say that,
I thought we were giving everything away soon in another month.
So 0% rent increase, it's so unfathomable. Expenses don't go up 0%. Utilities, property taxes, union labor contracts, they go up every year. So now there's no money to put back into these units, and it just affects the underlying residents that live in these communities, in these buildings.
Yep. And then there was a 2019 bill that had a similar limitation that used to be in New York for these buildings. You could invest capital and then earn a return and of the capital and return on that capital. And that was killed in 2019. And exactly to your point, Jason, landlords have stopped investing and they'd rather take, apartments offline. So it's actually reduced supply because many of these apartments that had been occupied for a long time, they don't even, it's not even safe to release them without investing capital. And no one has an incentive to invest capital.
Yeah. So what we're really talking about here is this balance between what we'll call over-regulation and kind of having some necessary safeguards and guardrails.
Always need guardrails.
So what comment in a little bit more on that, Jason, as far as what you're seeing? You've mentioned some good things happening in California. I know you're involved in Texas as well and other places, but you think we're reaching an inflection point of balance, or do you think it's still weighted toward overregulation?
It depends on where you are, of course. So California is the extreme in terms of regulation. I'm sure New York is as well. Look, there's certain good things too, right? Especially at the federal level, we have the low income housing tax credit program, or LIHTC, which has created 3 million affordable, something like 3 million affordable housing units in its history. You have public-private partnerships. We've got Fannie Mae, Freddie Mac, and HUD, which are really providing low-cost capital to developers who are looking to build or refinance their assets or reinvest in their assets, especially when there's an affordability requirement. We have, the big one we take advantage of are public-private partnerships, where we can go in and similar to I know it's 421A or 467N, I forgot that acronym, but that number. We do leverage those programs around the country to be able to both invest in our assets and also convert and set aside units for affordable tenants. So there's definitely good things happening around the country and at the local and state level, but California is certainly the extreme. It's the extreme.
Yeah, it makes it difficult. Let's go one step further. Let's talk about politics versus housing production. We've been touching on it, but Scott, you've been fairly outspoken over the years about candidates. You've engaged with them, particularly those that their agendas may threaten development. But you've also had a lot of constructive dialogue. I know you've met with the gentleman Mandami, who's running for mayor and likely going to win the race. But how should the real estate community as a whole engage in politics without being constantly vilified? Because the American landlord, in a way, has become a pariah of society rather than a hero.
And that's a good point. And I think, I think the way that Jason and we sort of run our businesses, I think, are a little different than that. And what it takes, when you're thinking about engaging in development is a astuteness about politics, right? And about building consensus. And when you do that, my view is you need an air game and a ground game, right? It's good to have the relationships with the elected officials, the policymakers, the people, that are driving government, but you also need to be reaching out to the people in the communities in which you're developing so that they have input into what ultimately is going to be built. They have transparency and a sense as to what that is, and that you're advocating. And so when we approach large master developments, we're doing a almost $7 billion master development in the Research Triangle in North Carolina. It's like running a campaign, a political campaign, in terms of building support from the community at large. At the same time, really cementing and aligning yourself with the elected officials and government so that they see this is going to be a win-win. But you got to also make it easier for them to make sure that you help them get the public support in that mix. And
so you're really barbelling your strategy both at the top end and at the
I think the developers, the days of developers saying, here's the plan, here's what I'm doing, take it or leave it, is
over.
That's over, right? There's a much more, heavier lift to get these things done today. And again, we do also, as you mentioned, airports, same thing. I mean, we're doing a $4.5 billion airport terminal, being able to build the consensus locally, hire locally, and that's also part, like when we're building as a master development in a community, we'll start a year before we start developing job training so we could hire local people, right? And put them through certification so they don't have the skills. We get them the skills. We'll work with the schools for mentorship programs. We'll work with the local small businesses so they're not gentrified out, but that they can actually rise as the customers are there, right? So I think you have to take an economic development approach when you're working in these communities, not just a development approach when you're working in these communities.
Let's talk about the project. I think you did at LaGuardia, correct?
JFK.
JFK, Terminal
6.
let's see, what airline is out of there? Not Delta. Who's
Not
out
yet.
of
It's
there?
going to be, well, it's going to be, it's not open yet. It opens up next year, but the Lufthansa, ANA,
Okay.
so it's a $4.5 billion terminal that will be next to JetBlue and,
Yeah. And a
um,
TWA hotel.
and a TWA hotel. Exactly. Right. So,
So talk about that and how you got involved with that, why you got involved with that, and so forth.
yeah. So, part of my background is I've done a lot of public service, and I was the New York head of the Port Authority of New York and New Jersey, appointed by Governor Cuomo,
A small
primarily
job.
right, small job. But when I took it, it really was to finish the World Trade Center, which was paralyzed in 2010 with infighting with all different stakeholders. But besides that, there also was you run the airports, the bridges, the tunnels, the police force for the Port Authority, amongst other things. And so it's a pretty a big agency,
How
bi-state
big is that
agency.
budget, Scott?
I don't
How many
remember off the top of
billions
my
is
head.
that
It's a lot.
budget?
It's a big budget, but it's a self-sufficient agency, right? So this was a an agency that's controlled by the state of New York and New Jersey, formed by Congress 100 years ago, and it's meant to have independent revenue sources that enable it to grow through tolls, bridges, airport fees, et cetera.
Was it
Uh,
born out of the development of the World Trade Center in Lower Manhattan when
no,
Silverstein started, or what
No,
started
no.
it?
This was in the it started with the fact that ports in New York and New Jersey were shared, right, in terms of
Ah,
ports,
okay.
right, and then it went to airports and actually the World Trade Center was really a sort of mission creep, to be honest with you, right? That was not really part of its mission, but it's this bi-state agency. But in
They
any
took
case,
over the
when I was
administration
there,
of it.
yeah, when I was there, I began to advocate for using public-private partnerships, and it speaks a little to like Jason was alluding to before. And I remember, in one of my first pitches to the team there about doing a public-private partnership, they said, "Why would we do something that where we have to pay the private sector a mid-teens return when we borrow at 4%?" And so we don't need that. And we decided we had two bridges that were going to be built, one in New Jersey, one in New York. And we said, we'll do the New Jersey one on the port's balance sheet ourselves and self-perform, and let's do the New York one as a public-private partnership. And the New York one was finished on time and on budget. The New Jersey one was 2 years delayed and $300 million over budget. And when you ran the IRR, that cost of capital was probably like 35%, and ours was, on a blended basis, probably seven, right?
And what
Because
was the difference? Was it just a timing issue? How it was
yeah, it was
executed?
just what you see is that when you bring the private sector into public-private partnerships, is there's a discipline, right? That you really understand what you're doing before you start doing it. Whereas if it's just the public sector, they want to break ground while that elected officials in office, and they just start going. And whatever the cost is, it is. We're not going to take that risk. So you make sure you understand the scope, you value engineer it, you make sure you're ready before you go. You bring innovation, you bring expertise, you monitor it the whole time, and that's the thing that people don't appreciate. It's not about the money; it's about the discipline and the expertise that you bring to the table. And
Well,
so,
ultimately, didn't the
Just the reward.
taxpayers suffer from that overrun?
yeah, they all that happens at every time, right? And then we took that and said, let's do LaGuardia Airport, and we did a
Yeah.
private partnership with LaGuardia Airport, which we did this RFP on, and was very successful. Now went from the worst ranked airport in the country to the best ranked airport in the country, 65% funded by private dollars, and again, really focused on customer experience, passenger experience. And then when I left the Port Authority in 2015, I took a team on infrastructure, and then we ended up winning the mandate to do Terminal 6 at JFK, with this group Vantage, which was the group that actually was doing the LaGuardia thing. They're an airport management company. And now we're delivering our first phase in 26 on time and on budget, and we'll have the second phase done in 28 as planned. And it's 100% financed with private dollars.
Talk about doing good while doing well. That's an incredible feat. So RXR will then own it or be turning
Yeah,
it
no,
back?
we'll own it. No, we'll own it through we have a 40+ year leasehold effectively, and we'll manage the airport with our consortium Advantage and our partners. And then and it's almost like you think about, you have an anchor, Lufthansa, ANA, and then you have little spots that you fill with other Alaska Air, other airs, right, that pay a little bit more for having flexibility. And then we have all the concessions, all the retail concessions that play through. And in this case, it's an international terminal. So we have the ability for people to come in, get right through, and then get into domestic, go right to JetBlue, right? And we have our own TSA there. And so we're able to just, move people, and it's more boutique. It's 11 gates.
Yeah, it's really a rental play when you come down to it,
Yeah.
right?
Yeah, you just got to understand what the airlines, what they're looking for in terms of their needs, and try to build a more bespoke revenue package or cost package around what they would need.
I agree. Jason, let me flip over to you for a second. You're dealing in your own world here with regulatory restrictions. A lot of it relates to affordable, but some market rate. What's the common misconception among politics and government about the work that you're trying to do that we need to correct? And where do you see the inflection points there?
So first of all, we spend more of our time fighting for more restrictions than we do against certain types of restrictions.
Interesting.
Sensible restrictions.
Talk about that.
Yeah, so one of the things that we have spearheaded around the country is the creation of new structures within the limits, or by expanding the limits of existing state tax code, to create new cutting edge public-private partnership structures where we can come in and create new affordable housing with sensible restrictions and sensible government incentives. So that's one of the things that we literally go around the country and pioneer. We've done it in Georgia.
How do you educate the politicians and the leaders on that? How do you do that?
It's a good question. I mean, we spent 2 years doing this in Washington State, and
that's all on your own nickel. You're not billing that to a project.
100%.
It's all advancing the work.
Correct. And if we fail, right, it's on our dime. It's all good. But if we're successful, we take the gloves off and we develop an enormous amount. We'll invest about $1 billion over a 2-year period, both in California and in Washington. So $2 billion total over a 24-month period on programs that we created, or sometimes we latch on to existing programs, but largely that we created. And to create both low income, so 60% area median income housing and lower, and mixed income, anywhere from 80% AMI to 120% AMI. So we spent a lot of time and diligence working with lawyers and lobbyists and professionals and governmental entities and agencies to create these programs.
You're really paying it forward for the benefit of what you do, but also what others in the industry are doing. So you're really paying it forward.
We like to hope.
You charge us back for it, Jason. I know you're helping me with some of my.
I've told you guys I'm here whenever you need to, right? So we do this around the country. So I know Scott, you mentioned you have a project. I think in Apex, we've got a property down the street from your project over there that we've done this with, and all over the country. So, but I think the biggest misconception that the public sector thinks about developers is that we're bad, and it's really unfortunate. I'll give you an example.
Pariahs. That's what I call us. Pariahs that are vilified.
They should be celebrating us.
Huh?
They should be celebrating us, right? We're the risk takers, the entrepreneurs,
They used to. These are the people that built the Park La Brea, Park Merced, Stuytown. These people were heroes.
I agree, 100%.
Well, I guess if it was easy, everybody be doing it, right, Scott?
Right. Well, and again, it's not. I don't think it's limited to developers, right? I mean, look at how bankers, right? I mean, I think the corporate. I really look back, and I think it really was the great financial crisis. Was a turning point where there was this big distrust of banks, big government, real estate, big business, and that's. I mean, that's really, if you look to sort of this polarization that we've seen in the political environment, is really, I think, stems back from that period. And there's a large franchised, to a great franchise.
Remember the march on, was it the March on Wall Street? Where
right, it was a march on Wall Street, and right, they had the tents there, and I don't think it ever really went away. And then there was a whole, from that, a whole segment of the population that came into the workforce at that point where there weren't jobs. right? And there's this sense of, and everything, I don't have the same opportunities that other people have. The cost of living is getting higher. And so that is, I think, what has led to the populism that Donald Trump has, been able to tap into, and the same populism that Mamdani has tapped into, totally different
On opposite
ideologies and
ends of the
approaches to it.
spectrum.
But it's the same issue, which is people are looking for an answer, a simple answer to a complicated problem.
But
But what
both
people
of
don't realize
you
too,
are
people don't
pragmatists.
remember, it's an inconvenient truth, is that the great financial crisis stemmed from bad public policy from the
Right.
early 1990s. And that's when Congress
Sure.
said everyone should be able to realize the American dream and own a home. And policy shifted. And that was the precipice of lax lending. And of course, Wall Street took advantage of it, which, but it really stemmed from bad public policy. Not everybody should own a home.
No, you have people with, let's say, household incomes of under, call it 75,000, buying $800,000 condos with a rising interest rate market. That's not going to work.
And then cut to that crisis created the great financial crisis, created a lack of jobs in construction. People left the industry in waves because there was no construction jobs. They didn't return. Builders spent years on the sidelines, not able to build as the supply was absorbed. And then what happens? Money becomes cheap again. And well, I'm sorry, before that even happened, but then you had a housing crisis stemming from the great financial crisis. It all started at that inflection point where building stopped. And building stopping now for other reasons, a combination of reasons. Interest rates are elevated. We've got too much supply again. So the pendulum will just continue to swing back and forth.
And when we say we have supply again, I mean, I think we have a short-term supply in
Agreed.
certain areas, but I mean, when you look at a macro, we still have a major shortage, right? And the cost for a home is up 50% in the last 4 years, right? So that's a problem that we
Lack
have.
of supply.
And I think the issue, just to follow Jason's timeline of things here, because I think we're in a situation where the problem is being exacerbated now, right, by higher interest rates, which again slowed down construction and made it more difficult to build new supply and more difficult to afford housing. And now, when you talk about on the construction workers, there's this distortion of what's happening in the economy with the digital economy sucking a lot of the construction industry towards those projects because they're better paying, longer tenured type projects. And so there's going to be a squeezing out of resources, construction, capital, and attention, frankly, to things like housing that is most needed in this country right now.
And by the way, what Scott and I are saying is this is good for our existing business, right? Our existing assets that we own will be the beneficiary of vacancy decline and rents going up. So we're not saying this because we're being, from a selfish perspective. We're saying it's the reality is that there is going to be a future affordable housing crisis unless we continue to build. And that, it helps us, but it hurts the common.
Yeah, I mean, to your point, I mean, right, you have the building permits are down 75%, right? So, and that's across the country. So it's just going to continue. And then even for home builders, if you're not one of the top 20 home builders, you can't get any financing to build vertical, right? So even if there's lots that you have or you could buy, the regional banks aren't providing you with that financing to build vertical. So there's so many aspects of this right now that I think would imply that this housing, shortage is going to continue to be an issue, and it's going to require creative thinking. Maybe, one thing we're talking about policy that I've kicked around is something that I'd use on the infrastructure side, which is, loan programs that are below rate interest rates to build housing. And, that's what we're doing. We're using it, for our transit-oriented developments where we can pull money from the federal government that 50 basis points over treasuries and or to 1 basis point over treasury, depending on where you're at. And
why couldn't Fannie and Freddie do that? Why couldn't they extend their lending programs to developers as well?
Go ahead, Jason, you're going to say something.
Yeah, I was going to say, well, before you said about extending their credit rating for developers for ground up, in essence, they do by guaranteeing loans, takeout loans, right? So they start
in the beginning stages is what I'm saying.
So they're starting. So actually,
so forth.
Yeah, and HUD's starting to do it too, right? But the issue is it gives certainty what it doesn't do is reduce the cost as much, right? I mean, the issue, what I'm saying, and when we use it, the programs that we use, like there's a program called RIF, which is a railroad infrastructure program. There's a program called TIFIA, transit infrastructure program, is that the rate is low, right? So it enables you to reduce the overall cost of your project. So not only do you have the guaranteed financing and it's long-term financing like Fannie or Freddie, we could have 35-year self-amortizing financing. But you could also it's the lower rate reduces the cost. Just having the financing isn't going to solve the problem for housing today because of the increase in cost.
Yeah, I completely agree. Let's talk a little bit. We're sort of talking about it around the edges, but capital providers on the private sector side, let's talk about them as it relates to housing policy and how they're feeling, maybe in some cases more selective, more cautious about states and local areas where there's high regulatory burdens. How do you navigate that, Scott? You're a master of finding capital to fit needs. I know you just did a huge adaptive reuse up in, well, you are doing it, I think, up in Westchester County. So that
Yeah.
must require a lot of capital. How do you balance out all of that with your capital partners? Where there's
I mean, listen, I think, well, first I'll say this, we're in the lending business too, right? So I think I look at that even more so because we're in the seat of having to be selective ourselves. And, to this point, and probably on point, we did our first deal in California, just a couple of months ago, but we haven't lent anything in California, built anything in California because of that regulatory environment, right? And I think and in New York, obviously, we're very selective. We know how to navigate New York better and have a better lens into what's potentially in the pipeline of risk associated with that. But, it clearly chills capital if you understand it. Like I'm sure Jason understands California and we understand New York, you can exploit that hole, right? And because everyone paints everything with the same brush, and you can then say, well, that's not really what this is. And so it becomes an opportunity. But banks are net neutral, right? They've not increased lending at all, right? If they're lending to real estate, they're lending to real estate at a net basis by lending to lenders like ourselves or Apollo or others that as back leverage that are lending to real estate today. And I think that's going to be more permanent than less permanent because of the cost of capital associated with the charges that they need to take, the wounds that some of them still have, the fact that some of these the amount of maturities, this $1 trillion+ of maturities that still lie in the system that need to be refinanced over the next few years. So I think that chills the capital. The other thing on capital, and I said it earlier regarding construction, is when you think about the big capital providers around the world, they comes when it comes to real estate, it's in the real asset bucket, and the real asset bucket also includes infrastructure, digital infrastructure, and then real estate. And what's happening with the data center, boom that's out there, and the scale of those projects, the Meta Blue Owl this week, $28 billion, one project, $28 billion. How many multifamily buildings would we have to build for $28 billion?
One project.
One project. So that basically takes capital away from going to things like housing or going to traditional manufacturing or industrial
Sure.
buildings, right? And so that's happening. And when I meet with investors around the world, I hear that all the time now. They all need to have their allocation of data centers, and
Yeah.
and they haven't gotten money back from past investments. So with what they have, that's where it's going.
Yeah, if they're putting out 30 billion and 28 billion is going to a data center project, 2 billion is going to multi, and suddenly you're scrounging around for capital. So it's it's a combination sometimes where bad policy, over regulating the banks and not allowing them to a little leeway here doesn't help, doesn't support some of these more local initiatives, if you will.
Yeah, and again, banks, the regulatory environment, under the Trump administration has definitely become, more friendly, right? And businesses feel it, banks feel it. There's going to the Basel III endgame, which is the regulatory side of the bank that was going to come out. The rules under the Biden administration were pushed off and are going to be much more laxed than they otherwise were going to be. But still, the incentives even, just would argue this is where you're going to invest, and the profit motives, right? I mean, I'm not saying this it's going to be, but I mean, just as Jason was talking about the housing bubble, this is that you have a data center bubble and all this, the bonds that are being issued around data centers and loans being issued around data centers are being distributed throughout the whole economy. Your pension system, I guarantee you, Bob, has, a data center in there right now.
I'm sure they do. Jason, let me pivot over to you. I think you were predicting the housing bubble before there was a bubble. I remember you sold a lot in 2005, 6, before the downturn. I thought that was smart. But what do you think institutional investors are now becoming more cautious in your world? And how do you think that's playing into? Do you think they are becoming more cautious, or you think they're letting up a little bit? What's your feeling?
Are they being more cautious? Absolutely. There's certainly a flight to quality, higher quality assets. It's so interesting. So when I started my career in multi, it was all about the gateway cities. And you couldn't even utter the word Texas or the Sun Belt and attract institutional capital. This is in the early 2000s. And capital was attracted to the gateway cities. It started coming into the Sun Belt, certainly in the kind of mid 2010s, but it didn't depart the gateway cities probably until 2017, 2018, and now it doesn't want to touch them. So it just follows this horde mentality. So right now there's a major dearth of capital focused on California, Los Angeles, San Jose, even though that's actually one of the hottest markets in the country right now, and definitely the most expensive market in the country.
Big rebound.
Yeah, Los Angeles, right? So what we've seen now in California is exponentially wider cap rates than where they were. There's been no value creation in California real estate, basically in any asset class, since somewhere between 2015 and 2018. So the values at which deal prices are struck today are in line with 2015 and 2018. And so we've been taking advantage of those opportunities. And capital, institutional equity capital, is very selective about where they'll place their money on the West Coast. So we've been looking to alternative sources like the tax exempt municipal bond market. So that's one of the areas we've kind of tapped into. There's still
Also use the welfare exemption, I think, right?
We use the welfare exemption. We do tax exempt bond issuances. California tax rates are so high that there's still this thirst for tax exempt debt. So that's been one of the ways we've been successful in able to finance our projects in the West Coast, specifically in California.
Well, let me come down to the wire here. So, Scott, back to you. If you had the power to change one thing, whether it be zoning, financing, permitting, whatever it is in your world, what would it be?
Power to change one thing.
I know there's many you'd want to change, but
right. I mean, I guess what I would say is if I had the power to change one thing, I would probably try to find an objective, form of governance and policy setting for things like housing. Almost like you have policy setting for monetary policy, right? These are tough political decisions. So, people that have to make them are under a lot of pressure. If you could create an independent board that have, longevity that, don't necessarily have to be voted in by the public, I think they'll make better objective decisions for housing policies.
You're saying at the federal level or what level?
Even at the state level, just as a matter of, I think if you can find a way to remove the local politics out of housing policy, and I'm throwing that one concept out, but that's the challenge, right? Is the parochial local mentality just has, and you said it in the beginning of the show when Jason was talking about the state, there's going to be lawsuits, there's going to be trouble, and that creates problems, right? And I'm hoping that the fact that this housing shortage is so acute and the affordability issue is so prominent, that starts to spark an ability to think more creatively about how we're going to put policies going forward.
That's a very telling statement because a lot of the hangups are at the local government level. We've seen that in supply constrained states like Massachusetts, where the governors there have had to try to figure out policies where they could penalize some of these smaller towns that are not meeting their housing, let alone their affordable housing requirements. Newsom started doing that, suing communities that weren't, following any of those guidelines either. But it's still a tremendous, tremendous effort. And that's why Los Angeles zoning laws are half a century behind the demographics.
No.
Jason, let's switch to you for a second on that. What would be your one pick if you had to make a pick on what you would change in housing policy? What would it be?
My message to cities and governments is let developers do what we do best, and that's develop and build. Take the gloves off, right? No one wants to live in a rundown old building. Everybody wants to live in something newer. So let developers build. If you build new housing stock, it's going to force the owners of older housing stock to improve it to be competitive, which is just going to increase the quality of housing at the lower end. Just let us build. Take the gloves off.
So, or as Scott said, supply, supply, supply. So as you know, the theme of our podcast is building better communities. You're both doing that in your own way. I know, Scott, you've been very, very engaged civically. You're also very, very philanthropic. Maybe talk about some of the things that are important to you that you're doing a little bit outside of your day-to-day involvement with rebuilding malls and airports. What are some of the things that I know you've given some nice contributions to Norwell Feinstein to help with AI related research. You've done a lot of things, but talk about a little bit what floats your boat.
I mean, right now, probably the most time-consuming part of my extracurricular activities is at the Federal Reserve, the New York Fed, because that's that's something we meet every 2 weeks. There's a lot going on there. I'm on the Audit and Risk Committee, and so there's a lot that relate to Fed independence and other things and monetary policy. So that is a big area. The other thing I think is anywhere that we could start thinking about the future of technology and how it impacts the way that people live, the way that people work, the way people are cared for. The speed of that change is unbelievable, and it's global. And we're fortunate in the U.S. to be a leader in that space. But it's going to create a whole nother set of opportunities and challenges that we have to overcome. And one of my big views on that is while there's risk to implementing large language model and AI type programs, there's even bigger risk to move slowly in implementing that. And so that's something with everything I'm involved in, from our business to my public and charitable and philanthropic type activities. I'm focused on driving those changes and moving things at a faster pace, because that's where the world's going.
Well, I think you're spot on there, because technology can help us in real estate and in healthcare and everything else. So,
and then just to this point, like labor, right? I mean, we're talking about robotics are going to be important, new tools to accelerate things. We're not, whether it's immigration policy or just dropping in population, we're going to need our aging population. We're going to need more labor, and so you have to find ways that we can leverage technology to maintain the quality of life and the strength of our communities going forward.
Jason, you and Gar are very involved in the community here in California. I know you're on the board of Governors of Cedars. You're involved with Wags and Walks, but I know the prison system is a big focus of your charitable work with the Anti-Recidivism Coalition, better known as ARC. Talk a little bit about that, what it means to you, and why that's important.
So I've worked with ARC for over 10 years now, and
I'm going to take my tour. Don't
100%
let me forget.
We're going to get you to go to Lancaster Prison. It is.
I can visit one of my sites out there. Perfect.
Very sobering. So what ARC does is we provide supportive services inside of prisons. We provide, we work at the legislative level, especially in the state of California, on legislative reform. And then post-prison, we provide both housing and social services. And the sole objective with the latter is to reduce the recidivism rate. California recidivism rate is around 70%. Inside of ARC, it's somewhere between 3% and 5%.
It's a very successful model.
It's incredible. And look, casting aside the humane aspect of this, which is primarily why I'm involved, it's also good business. It costs $75,000 a year to incarcerate someone in prison. It costs nothing to set someone free and have them become a good part of society, paying taxes and not committing crime. So it's a good business model, but it's also humane as well. There's a lot of when you come with me on the tour, you'll hear the stories of so many of these individuals, and a lot of them they've done their crime, they own it, but they're also they're a byproduct of the society that they grew up in. So something I'm very passionate about.
Yeah. Well, thank you both for coming on the podcast. You are setting a great example for our industry in what you do day to day, how you've trying to help the housing industry and the things you're doing personally. Scott Rechler, iconic New York real estate developer, owner, airport rebuilder. Jason Post, 45,000 units throughout the United States. A lot of them are affordable. Thank you for both coming on.
Thank you, guys.
Thank you. Appreciate it.
All
Pleasure,
right.
guys.
See you soon.